Hello, Internet friend. Today on Value Side, why Wall Street was bound to hate Trump's tariffs. I'm David Ravel. Well, it's easy for investment outsiders to underestimate the pressure to perform on Wall Street, from the largest mutual or hedge fund manager to the lowest regional stockbroker. The demand to produce solid returns year after year is intense. It's the reason many financial professionals hang up their careers prematurely. Above all else, it's performance that counts. And it's also why President Trump's tariffs drew such a violent reaction from the financial markets. One afternoon, Trump literally threw over the tables of the money changers, to use a famous quote. You see, Wall Street had pushed for half a century to develop a business plan that optimized profits while steadily reducing fixed expenses. Our story began in 1964 in the bucolic town of Beaverton, Oregon. Two enterprising young entrepreneurs, Phil Knight and Bill Bowerman, opened a new company that would produce a masterful running shoe and changed American manufacturing. Bowerman was the former University of Oregon track coach, and Knight was one of his athletes. Bowerman developed the concept of a super light track shoe that would eliminate the extra padding and support of the older shoes. From the very beginning, athletes recognized the benefit of this lighter-than-air footwear. In the first year, Blue Ribbon Sports, the name Nike would come later, sold 8,000 pairs, which is not bad for a startup. However, what made Nike stand out as a revolutionary business model was that from the very beginning, Nike produced its shoes overseas, initially using a Japanese manufacturer, later moving to China. It helped that Nike was located in the U.S. Northwest, just a short flight from Asia. Now, Nike moved production to China shortly after President Nixon opened trade agreements with that country, which made it the world's manufacturer, quote-unquote. And just like that, Nixon created Wall Street's ideal production model. Nike showed the world that they could variabilize, to use a phrase, the fixed expenses of operating a factory and hiring workers. Nike moved all of the costs of workers' compensation, factory maintenance and development, insurance, safety, liability, pollution control, and natural disasters offshore. Instead, Nike would concentrate on sales, marketing, and developing even better products. At last, Wall Street had found its near-perfect retail business model, a company that produced a popular product with the lowest possible fixed expenses, a model well-suited for the up-and-down retail environment. When times were terrible, Nike could quickly reduce their offshore orders while avoiding the troublesome issues of laying off workers or closing plants. And when times were good, they could ask that offshore manufacturer to put on an extra shift. Although Nike was the first, Apple Computer would perfect this business model, a model that combined offshore production with American marketing and development. Most are familiar with Apple's history, including how Steve Jobs and Steve Wozniak began the company in the family garage, and how both founders initially left the company, with Jobs returning as CEO in 1997. Now, in his second stint as company leader, Jobs fully adopted the Nike model by outsourcing Apple production to China. And from that time onward, Apple steadily climbed to the world's most valuable company, and in the process became a premier performer in the stock market. Apple finally achieved that coveted #1 position and recently topped a market capitalization of $3 trillion. That is, until Donald Trump came along with his Liberation Day, the day he revealed his global tariffs. While his tariffs were aimed chiefly at American trading partners, they hit Apple squarely in the balance sheet. Apple's current CEO, Tim Cook, anticipated that Trump would likely pose tariffs on China, so he moved some of the production to other Asian nations. But in the end, it didn't matter. as Trump slapped tariffs on all the countries that produce Apple products. In a 45-minute White House Rose Garden presentation, the president demolished Wall Street's favorite production model, which Nike began over a half a century earlier. Suddenly, the tremendous cost advantage of offshore production was declining. By making imported products more expensive, the president moved the nation closer to a made-in-America marketplace. While even Wall Street might agree with those sentiments, American manufacturing plants lie far in the future. As we said before, what counts on Wall Street is today's performance. What have you done lately is their mantra. And a new quarter has just begun. As noted, money managers will be judged on how well their performance is this month, not sometime in the distant future. From Wall Street's perspective, Trump has just benched the market's best performer, along with several other of the Mag 7, limiting the nation's best and most profitable business model. It should come as no surprise that Wall Street threw a hissy fit. Only time will tell how long it will take for American multinationals and investors to adapt to this new way of doing business. Now, if you enjoyed this podcast, please consider buying me a cup of coffee. Go to buymeacoffee.com/David Revell. That's REAVILL. Buymeacoffee.com/David Revell. Thanks for listening.